I'm going to get to that here as well. All right. I'm scrolling back up. This thing is reversing the comments on me again. Fernando said that any strategy in this market is volatile, so you need to make sure you have the proper sizing and the proper positioning as well. Okay. Fernando commented earlier to what I mentioned. In this period, I have several calendar puts that I hedge with specific quantity of stock. If the underlying goes up, this allows me to rotate the payoff in favor of the direction. Do you think it is a good idea? I don't know. I'd have to look at it. I see what you're doing. You're essentially doing a married put. If I take the long put component of the calendar put spread in that situation, then you're selling a put option against it for the second component, and you own the stock. Well, yeah, you've got sort of a hedge position with a naked put. And the risk is if the stock falls quickly, you said that you're able to adjust and roll it if the stock falls. Well, you've got a naked put and a married put, or you could say you've got a calendar put spread and a long stock. Something's uncovered. Either the long stock position, in this case, so we take, over there, we take the married put position and you're adding a naked put to that, which would kind of give you, this profit and loss type of chart. So the trick is something is uncovered down here, whether it's you can call it the stock position, because that long put is only covering the stock, or the short put. It can't cover both. So you take an increased risk in volatile markets to take a capped gain and limit the growth to the upside without extensive management. Again, you're asking, is this a good thing to do? Well, if it's worked for you, it's because it's been the right market conditions. Are those correct market conditions going to continue, where this sort of profit and loss structure can work long term? Yes, you've got minimal risk here on the married put that you started with, but then you added full risk of just owning a stock back in by shorting the put option. Or you did a calendar put, now you've got a long stock that has full risk. The long put can only cover one. So if you're finding yourself, you're just in this range, you're rolling a short put up or short put down and back and forth, and you're still in this protected position, the market conditions over the time you've been using it have worked out for that. If the market starts swinging wildly one way or the other, you might start entering losses to the upside and losses to the downside. I can't guarantee it's going to continue, so that's why I can't say that it's a good idea. If it's working for you now, I mean, it's a good idea. But you see the issues here, is that you're taking a position, an idea that had a guaranteed limited risk structure, by trying to generate premium by selling an out-of-the-money put that you hope will expire worthless and the stock won't have a big move. You've thrown it out the window to take a risk on this side and potentially have a loss on the upside based on your current structure. So volatile market, this has been working out for you probably because the premiums you're generating, but it's tricky, as Sam mentioned, and as I've been saying, because of the fluctuations, they can come back to bite you very quickly on the downside or on the upside. Okay. All right. I'm sorry. I thought this was Jim. I was wrong. John. And he says, Mike, in the backtest module, using the backtesting tools, is it possible to track a hypothetical married put position through the life of the trade along with the potential suggested adjustments? No. I'm just going to answer that directly. It is not. I believe that would be a valuable learning experience. Okay. So the issue is that you can simulate manually the income methods yourself or adjustments to the married put trade, doing it manually, but it can't do it for you. Okay, it doesn't have that capability to convert one position it found in a back test to other positions. Okay, it doesn't have that capability. So I've run the Smart History Excel as far back as I can go. During your 14-day free trial to Power Options, you will get 3 months of access to the historical database where you can run searches and all the strategy to see what would have appeared on that day. Oh, that's interesting. Oh, I'm too far back. I'm too far ahead now. Okay, that's exactly the time frame. It's the 2 months back I have, I guess, there. 3 months back since we're on August 30th. I should have thought of that. Anyway, okay, so on July 1st, the married puts that would have matched my criteria are going to come up here in a second. Okay. Kulik and Sofa at 23, so on and so forth. Okay. Now, once you have these results, you can calculate the group results to see how they performed. Now, this is something I'd use with bull put credit spreads. I run a search on July 1st to see which bull put credit spreads matched my criteria. How did all of them perform between that date and expiration? But really, I'd only be focusing on the top 3 or 4. Now, what I can do, of course, is you can also analyze the individual position. Now, this just shows me a breakdown of the changes in price, okay, over the time period. The max, oh, this wasn't a good one. The max return was 0.3% on 7/24, and the max loss was on 8/14, and then it's come back a little bit since then. So it's, you know, right now only $1.34 down on the trade. But yeah, you can see here, here's the put, I'm sorry. There you go. There's the option price, really high. What does that mean? The stock failed really bad, but then it came back up, so the option premium went back to normal. The stock's back up here. So 8/14 was the worst loss here when the stock was down at $20, and even though it hit that again later, 1948, implied volatility must have pushed this up higher, so it wasn't as big of a loss as we would have seen on 8/14. Okay, but what, as I mentioned, what doesn't this show you? What the income methods would have looked like. So John, I'm sorry. Sorry, John, I'd have to do this manually, and I'd say, okay, what are my 2 points here? On 7/24 is at 0.3%. So now I can go to the historical option chain and say, okay, well, on 7/24, what were the call premiums? What would it look like if I did a bear call? Okay, so I can look at, you know, kind of guess what the selling premium and buying premium would be. I could look up the income method number 6, the bear call spread on 7/24, and see how that performed 8 or 10 days in. I can look what was going on at 8/14 and say, well, the stock was at its lowest point. The stock had dropped down about that $20 per share or a little bit lower. What if I had used income method number 9 or one of the other income methods, and then I could look at that on the chain to see how that put would have performed versus just leaving the position alone. I'm essentially manually looking at 2 to 3 different positions. That you can do, okay, but it doesn't calculate the income methods in for you. It's just, that's just way too much to do in the historical tools. It would have to be a completely separate program. And I'm not saying that can't be done, it's just right now it couldn't be done in the way that this program would be written. Okay, all right, let's see here.